every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Friday. This is Peter Lewis with the final Money Talk of the week. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And thank you for making this podcast one of the most listened to financial podcasts in Hong Kong and Singapore, according to Podstatus. In today's business and finance headlines, US headline inflation in July ticked up slightly from June, but the rise was lower than expected. The consumer price index rose 0.2% from June to July, matching June's advance and in line with market forecasts. The CPI increased 3.2% year over year. That's up from the annual rate of 3% in June, but below economists' forecasts of 3.3%. But it does mark a halt in 12 consecutive months of declines in inflation. China has criticised President Joe Biden's long-awaited executive order restricting US investment in certain Chinese technology sectors. However, Beijing stopped short of issuing countermeasures, although it reserves the right to respond. In a statement Thursday, China's Commerce Ministry said this seriously deviates from market economy and fair competition principles, undermines the international economic and trade order, and seriously disrupts the security of the global industrial and supply chains. The Reserve Bank of India held its policy interest rate at 6.5% for the third consecutive meeting yesterday, matching market expectations. However, the RBI said that headline inflation is expected to surge in July and August, led by vegetable prices, after a rebound to 4.8% in June. The RBI maintained its growth forecast for the fiscal year at 6.5%, while raising its inflation forecast to 5.4% from 5.1%. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Nitin Dialdas, Chief Investment Officer at Mandarin Capital. With a view from Australia is Toby Lawson, CEO at Statton Partners. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks trimmed earlier gains but remained in positive territory on Thursday as markets further assessed the Fed's monetary policy outlook following new evidence of disinflation in the US economy. The data aligned with market bets that the Fed will refrain from raising rates in September, but the rally lost some of its traction after San Francisco Fed President Mary Daly stated the central bank could leave borrowing costs at a restrictive level for longer. The S&P 500 inched up just 1 point to 4,469. The Dow added 53 points, or 0.2%, to finish at 35,176. It was boosted by shares of Disney, which rose almost 5% following its earnings report, and after it announced an upcoming price hike for ad-free Disney Plus subscriptions. The Nasdaq Composite rose 0.1% to close at 13,738. Asia-Pacific markets were mixed Thursday as investors awaited the US inflation report, but tourism-related stocks in Japan and South Korea surged after China said it would relax pandemic-era restrictions on tour groups travelling to 78 countries with immediate effect. The list included Japan and South Korea, favourite destinations of Chinese tour groups before 2020. In South Korea, shares in Lotte Tour Development surged 30%, and those in Paradise Group, which runs casinos that cater exclusively to foreigners, rallied more than 18%. In Tokyo, shares in department stores climbed sharply, and airline stocks in China, Japan and South Korea also jumped higher. Chinese equities rebounded from morning losses following the US executive order restricting investment into the country's quantum computing, advanced chip and artificial intelligence industries. The Hang Seng Index closed the day with gains of just 2 points at 19,248. The Tech Index rose 0.1%. On the mainland, the Shanghai Composite was 1/3% higher at 3,255. Chinese property developer Country Garden, which missed 2 coupon payments on $500 million of bonds on Sunday, extended its declines, falling another 6.3%. Its property management affiliate, Country Garden Services, tumbled 4.3%. And in a filing to the Hong Kong Stock Exchange late yesterday, Country Garden said it expects to record a net loss ranging between 45 billion yuan, that's $6.25 billion US dollars, and 55 billion yuan for the first 6 months of 2023. That compares with a profit of around 1.9 billion yuan in the same period last year. And Chinese e-commerce giants Alibaba on Thursday reported revenue grew by 14% year-on-year in the quarter ended June the 30th to 234.2 billion Chinese yuan. That's about 32.3 billion US dollars, and that versus 225 billion yuan expected by analysts. And the company said it was driven by improvements across all of its business sectors. Net income rose 51% year-on-year to 34.3 billion yuan, handily beating analyst forecasts of 28.7 billion yuan. And US traded shares of Alibaba surged 5.7%. And you can get more details on the latest market movements in my daily newsletter, which is at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's a Friday morning, and I know that because I can see sitting opposite me Francis Lun, the CEO of GEO Securities. Like clockwork, Francis, every Friday.
Good morning.
And also with us is Nitin Dialdas, Chief Investment Officer at Mandarin Capital. Nice to see you as well, Nitin.
Good morning, Peter.
China has responded to the White House ban on US investment in tech sectors. If you remember, we discussed this yesterday. President Joe Biden issued an executive order banning US investment into quantum computing, advanced chips and artificial intelligence sectors in China. Well, China has responded. It stopped short of issuing countermeasures, although it does reserve the right to respond. And in a statement Thursday, China's Commerce Ministry said this seriously deviates from the market economy and fair competition principles that the US has always advocated. It affects the normal operation and decision-making of enterprises, undermines the international economic and trade order, and seriously disrupts the security of global industrial and supply chains. Francis, does it do all of that?
Well, not to that extent, but certainly it will hurt the tech sector in China, especially on this venture capital, because when you look at the first wave of Chinese tech stocks, internet stocks like Alibaba, Sina, and etc., they've all been helped by American venture capital. What Biden did was basically shut down the venture capital investment in the tech sector in China. So what it means is that China will have to look elsewhere, like Hong Kong, for venture capital if they want to start a new venture in high tech.
But what China has always wanted, the reason why it likes these joint ventures is because it gets the know-how, doesn't it, from these companies?
Well, not just know-how, but actually the money. Because,
do they really need the money?
Alibaba would not have become a big company without money from SoftBank and Yahoo, certainly.
What do you think, Nitin? Does it go as far as maybe... I get the impression it doesn't go as far as maybe people were fearing a while ago, and maybe the Treasury Department, which is the one that's been calling most of all for these restrictions to be very narrowly tailored, has won the argument, won the day.
Yeah, you're right. It hasn't gone as far. But I question it. You talk about national security, but you're actually saying that American companies can't invest into Chinese internet AI chips and all those kind of stuff. But national security should be the other way around, right? Shouldn't it be China not being allowed to invest into America? Because then they're getting the IP from those American companies. What you're stopping is Americans getting Chinese IP, effectively. So it doesn't really affect US national security the way I see it. I mean, I look at it as exactly as Francis just said. They just don't want the technology companies in China to get super strong. So they're trying to limit some sort of capital to them. But in terms of national security side, I think that's just an excuse and it's not actually reality in terms of if you want to protect national security, you want to know what's going on the other side, you want that knowledge, you'll invest into that company so you get that knowledge in and figure out this is what they're doing. That's how we protect national security. So it's an interesting play. I think it really is just to try and slow down the tech sector growth in China, especially on the high-end chip side. But it could have gone further. And I don't really think in the long run it's going to be too harmful for China because China will look at other markets and they'll get that money in one way or another if the companies are good. But it comes down to quality now. It's if the companies have got quality, people will invest. It doesn't matter where they are from the world.
I mean, to be clear, it doesn't ban investment, does it, in these sectors? It just means American companies have to get approval first before they can do it. But well, I don't know what the chances will be of them getting that approval. But I assume also that it's more has a bigger impact on JVs. If you're a company that enters into a JV with a Chinese company, then you are providing know-how as well, aren't you? So that's probably more going to be the focus.
Yeah, I would think so, and I agree with that. I think the JVs is where it gets hurt. But again, if China, these Chinese companies are doing JVs with all these other companies all over the world, and they can't do it with the American companies, who's falling behind here? It's not necessarily the Chinese company. It is probably the American companies in a certain way. So I actually think in the longer run, it's probably doing more harm to the American side of it than the Chinese side, because as I said, these Chinese companies, if they're good and they do have quality behind them, they'll find the money from elsewhere. Now, whether the UK decides it wants to follow the US suit and kind of put some sort of implications or banning in there as well, that's fine, because there's still Southeast Asia, there's the rest of Asia, there's Australia, New Zealand, there's Africa, there's a whole world out there. Where Chinese companies, Israel could be a good source as well, where Chinese companies can get money from, and they'll develop, and they will be able to do certain JVs with people in those countries. And so, yeah, as I said, I found it a very interesting one, the way that they played it. Yeah.
Do you think, Francis, we're at the end now, or close to the end of all these bans and restrictions? Is there anything else in the pipe, or has everything that they want to do been done now? Well, they're not going to be lifted, are they? We've got to live with them for a long time.
Yeah.
But is there anything new coming?
Well, I think the Chinese government's really disappointed with the Biden administration, because when Biden first took office, they had hoped that at least he would have lifted the tariff that were imposed by Trump, because that's hurting American consumer more than anything else. But he did not do that, and he expanded the sanction list and continue to limit Chinese access to high technology, and even getting Holland, Japan, and Korea to be on their side. So what the Chinese see is really American encirclement more than anything else. So it is really what the Chinese say is a Cold War mentality. Is them or us, is the enemy or us. So it's not good for Sino-American relationship going forward. I think Americans will lose the market share, except for Tesla and Apple. These two are too entrenched in China.
Do you think China sees President Biden as being worse than President Trump?
Well, from the action, yes, because Trump did not go as far as Biden. I think Biden has gone much further than Trump. But of course, Trump is much more irrational.
So can relations get back on track now between the US and China, as long as all these restrictions and bans are in place?
I doubt it. I seriously doubt it, because America is so scared that it will lose the technology edge over China. As in the 60s, that Americans are so worried about the Soviet threat. So I don't think relationship can get warmer in the near future.
What do you think, Nitin? Do you think President Biden says he wants to draw a line under the relations? He wants things to improve, and maybe there might be a meeting between him and Xi Jinping later this year. Can things get back on track?
I think at this point, like Francis said, it's very difficult, because America's saying one thing and doing another, in the sense, they've had these meetings, or they've arranged meetings with China counterparts, saying that they want to improve relations, and then every time they do that, they then impose another sanction. So it's saying, it's trying to show face, but at the same time doing the complete opposite. And I think China are aware of that, and they're not, being silly. But it's really down to politics, isn't it? It's about, how do I win this election? We're coming up to an election year. It's really all about, I need to win an election. What do I do? And China's easy prey. And it comes down to, if I show the American public I'm doing something against China, I get to win this election. The reality is it's probably hurting your country a lot more in the longer run. As Francis said, American consumers have been hurt by tariffs. We're saying maybe American companies could be hurt by this technology move. So you're actually, in the long run, hurting your own country, but this is purely down to win an election. And
it's about the only thing Republicans and Democrats agree on, isn't it?
Yeah,
as well?
Exactly.
Yeah.
And, going back to your Trump versus Biden argument, I mean, Trump, at the same time as playing the politics, he was also a businessman. So he knew how far he can go without necessarily hurting the businesses too much. Biden is just pure politician. So he's going further on the basis that's all he cares about is, I just want to win this election, and I'll do whatever it does, and I'll make me look good on that stage. Not necessarily caring so much about necessary economic impact going forward, I don't think.
Well, let's switch our attention to the economy. Francis, we've had quite a lot of economic data out this week, haven't we? On the inflation side, China's consumer price index dropped by 0.3% year on year in July. That's the first decrease since February 2021. So effectively, China's in deflation, isn't it? Both on the consumer side and the producer price side.
Well, actually, the deflation is caused by one item. The price of pork fell 20% last month
I was going to ask you about that. Does that mean it's just a temporary thing? Things are going to rebound?
I think so, because grain prices are going up again, and the energy costs are going up. The price of natural gas is shooting through the roof in Europe. And you have strike by oil workers in Australia, so energy costs are going up. So I think maybe next month or the month after next, then we will have inflation again. But I think the other problem is really the producer price, which continue to fall. And that really showed the weak demand from Chinese exports from all over the world. I think China is not the only country that's experiencing that. I think South Korea, Japan, and Korea and Taiwan are experiencing fall in exports. I think it's a global situation, so it doesn't speak well for the rest of the year. I think China may not enter into a recession, but it will not be able to grow at 5% as originally expected.
And should we be worried about this deflation? A lot of people are sort of saying that the government needs to do something. It should cut the RRR, cut interest rates, provide fiscal and monetary stimulus. Is it that urgent that the government does need to respond? Or
the government should do something because they have been saying it for months, and all we have is something like 21-point action, 26-point action, 31-point action, but they're all empty talks. I think they need to do something because the unemployment situation is really explosive. Half the 11 million graduates cannot find work.
And this is a big problem, isn't it?
It's creating a social problem. I think the government must do something.
Nitin, do you worry about deflation?
Yeah, I think China as a whole I'm quite worried about. And you're right, you can cut RRR, you can cut interest rates, but is that the wise move? Because the credit markets, as it is already got a few issues there. So do you actually want to start increasing credit more? I think what China needs to do is it needs to do a big PR job, actually, and it needs to start attracting overseas talent to come in there. It needs to actually allow foreign businesses to come in and operate and bring money with it. Because not only have you got an issue in terms of the local population, you've got demographic issues. I mean, you've got a declining population. So how are you going to get your economy back on track when you've got a declining population, youth unemployment at 21%, as Francis said, fresh graduates unemployment's at over 50%. It's social problem after social problem. You've clamped down on the private space. You say that you want to get the private markets back up and running, but again, it's kind of what I was saying about America. You say something and you do another. You're not actually following through with those actions where you're allowing private industries to reflourish. You're trying to target them into certain areas which is already done well, but that doesn't add creativity. It doesn't add anything new to what you've already got. So are you actually going to benefit your economy in any way that way. So I think it really needs a whole new a whole new outlook, and it's got to be a little bit less closed and a lot more like, no, this is what we are, this is what we want to do, this is how we're going to get it. Because there will be companies that will go into China, given the population as it is. I mean, you've got 1.4 billion people. Obviously, it'd be stupid not to try and answer it. But you need to start encouraging people to come into China and start spending money and bringing money with it, because you can't just do it domestically. I know the initial plan was that they could. I think they're now finding out they can't.
It seems to me, correct me if I'm wrong though, that the priority for President Xi Jinping is not the economy. The two things that he's most concerned about are firstly national security, and then secondly winning the tech war with the US. Trying to reduce its dependency upon the US, becoming self-sufficient in technology. Those two things seem to be a bigger priority than the economy, which is why we're not seeing the government really do anything.
But don't they go hand in hand? I mean, at the end of the day, if you've got a weakening economy, you're going to have a lot more social unrest because there are a lot more people unemployed. There are a lot more people not earning as much. It all goes hand in hand. So your national security, and that alone gets somewhat hurt over the fact that you're going to have internal social unrest. Like, I'm now struggling. I'm a young kid. I've got my ideologies. I've come out of university. I've got a graduate degree. I was told I can get a good job. I can't get a job now. I mean, how do you think that person's going to feel? He's going to get angry. The next person, and you've got 21, 22, 23% of that youth area that's going to be getting angrier and angrier by the day. So internally, you've got the social unrest. In terms of the tech war, the only way to improve the tech war is that you've got to be allowing people to be creative over it. It's not just going, because EVs worked in the past, we're only going to go into EVs. Or because this one industry worked, the whole way to win the tech war is actually to allow the creativity, allow the private guys to go out there and find and explore and find out where the boundaries are. And I don't think they allow that. And so is he, while that might be the focus, is he doing anything in reality to hit those targets? I don't think so.
Francis, why do you think Beijing's not responding?
Well, I think it was only yesterday that China opened up for tourism, group tourism to something like 30 or 78 countries. Yeah, including Japan, Korea, US, Australia, etc. So one data really stood out is that in the first half of the year, only 52,000 foreigners visited China. That is a shockingly low figure, meaning that in the first half of the year, China is still close to the world. I think what we need to do is really opening up China for foreigners to come and for Chinese to visit overseas countries. At least you have a tourism sector that will be rejuvenating and employing young people. I think that's one thing you can do, and sending more tour groups outward and then welcoming more tour groups inside. I think that's one thing you can do.
And this would help the employment situation with a lot of the young people.
Yeah, definitely.
That's jobs they could do.
Let them work in the hospitality sector. Let them work in hotels and restaurants.
What does... sorry, Nitin.
I was just going to say, I mean, I agree with you. They can work there. But again, you've got to look at what the youth want as well. They want that gig economy back too. And are you going to kickstart that? Because that's important too. It's not just...
So things like online education and,
exactly,
where they were tutors online and, providing language lessons and so on. And that got wiped out overnight pretty well, didn't it?
Yeah, exactly.
Yeah, I think they should reverse their policy.
What is the risk that China, well, when I say risk, that China exports its deflation around the world, and in turn that starts lowering inflation elsewhere in the world, makes it easier for maybe the Fed to stay on hold and not raise interest rates? Do you think this could happen?
That's what
that would be
happened
good,
to the first 15 years of the 21st century. Because cheap Chinese manufactured goods help lower inflation in the developed world. We used to have television costing $100,000. Now you can buy a Chinese television for about $6,000 Hong Kong. Very cheap.
Well, we had some inflation data out of the US. The Bureau of Labour Statistics yesterday reported that the consumer price index in the United States rose 0.2% from June to July. That matched the advance seen in June. It was also in line with market forecasts. The CPI increased 3.2% year over year. That's up from the annual rate of 3% in June, but that was below economists' forecasts of 3.3%. So I get the feeling, though, Nitin, the Fed isn't ready to celebrate yet, is it? It's too early to declare victory on this.
Yeah, I think with the Fed as well, it's not just going to be looking purely at the CPI numbers. They're also looking at the wage numbers. Until those job numbers...
And they're pretty robust.
Exactly. So until those job numbers start turning around, I think the Fed's quite happy to keep rates high and maybe do one more rate hike, even despite the CPI numbers coming down. I mean, I'm on the argument that maybe they should just hold and wait for a few months and see what happens over the next few months. But I do know that the Fed are quite keen to raise one more time in September, and then probably put a hold on it. And the other thing I don't think is going to happen that market's trying to price in is these rate cuts. Where they're trying to price in a whole bunch of rate cuts next year. I think the Fed's quite happy to hold at these levels for over a year and just let it just ride out. There are large parts of the economy that are benefiting. I mean, savers and companies with high cash hoards are benefiting a lot from the interest rate rises as well. So it's not just a case that if we lower rates, it's going to help the whole economy. It doesn't. There are a lot of people who are actually enjoying the higher rates and a lot of companies who do. So I think they're quite happy to keep the rates where they are with maybe one more rate hike in September.
But I think for ordinary citizens who have to pay mortgages, this is bad news because I think for the average mortgage holder in Hong Kong, you are paying twice as much as interest as last year. I think an interest rate cut will be very beneficial.
Yeah, but the flip side is, if you go back to pre-2006, what the interest rates we're paying currently is actually very, very low on a historical basis. In the 90s, people were paying 11, 12, 13, 14% on mortgage rates. 3% or 3.2% is not a huge interest on a mortgage. So, it's a bit of a give and take situation over here. It was artificially low for too long, I think.
And this may not be a victory yet for the Fed, but I'll tell you who it is a victory for. It's a victory for the monetarists, because they believe that inflation is a function of money supply, and money supply has been declining very sharply over the last few months in the US. So they've been warning for a while that inflation is going to undershoot people's expectations, and people are going to be very surprised about just how low inflation goes, which of course will be good news for us if that, so far it does seem to be coming true, doesn't it?
Yeah, definitely. I think if inflation goes down and interest rates falling, then it will be a big boost for the real estate market. Even in Hong Kong, prices have fallen to something like the level of 8 years ago.
Let me ask you finally about Country Garden, because this was once China's biggest property developer by sales. I think it's about number 5 or 6 now. It's warned late last night in a stock exchange filing of a large net loss in the first half, due to impairment on property projects and declining profit margins in its real estate business. In a filing to the stock exchange yesterday, it now expects to record a net loss of between 45 billion yuan, that's $6.25 billion US dollars, and 55 billion yuan for the first 6 months of the year. The previous year it had made a profit of about 1.91 billion. Sales are down 35% from a year ago and down 61% from 2 years ago, back in 2021. How big a problem is this, and how big a hole is Country Garden in?
Well, it is indebted to the tune of 1.6 trillion yuan.
About $200 billion.
Yeah, it's only second to Evergrande. So unless it receives a massive capital injection, and also a reviving property market in China, it will go under. Because it's really too deep in the hole. I don't see how it can go back.
Is this going to be then a bigger problem even than Evergrande? Because Country Garden has about 4 times as many projects as Evergrande did. So if Country Garden collapses, what's the impact?
Well, it will be catastrophic for China.
So the government can't let it collapse then?
Well, for the banks, it will take them 20 years to write off the bad debt.
Wow.
But you've got to draw a line at some point, right? You talk about Evergrande, we talk about Country Garden, we know a whole bunch of other developers that are also seriously in debt. At some point, you've got to let one of them at least go under. Because but
not Country Garden, surely.
Honestly, I don't know which one.
Or does it not matter?
How do you shake up this market? How do you get this market back on track? I mean, you're spending a lot of good money after bad if you're not going to ever get any returns out of it. So if you're protecting Country Garden by giving them cash in order to meet their debt obligations or some of their debt obligations, because they're clearly not meeting all, you're just literally kicking the can down the road. At some point, you've got to face these problems head on.
But the consequences of doing that for the property sector could be pretty disastrous, couldn't they? Because confidence is already bad. It will just destroy confidence completely, wouldn't it, in the mainland property sector?
100%, which is why they're not doing it. But like I said, I mean, there's so many issues at the moment over there, and it's just really crazy to think. I mean, at what point does all of it come to a head? At what point does, the unemployment part, the declining demographics, all of this is contributing as well to the fact that there is no property sales because there's no confidence in the country. So I think you've got to look at it in terms of what are the major problems at the moment which can potentially fix the others. And to me, it's starting with, let's say, confidence, but how do you get confidence back? You get people back in jobs. So let's go with, let's start focusing on how we can get people back in jobs. They start earning some money. They can then maybe look to upgrade and buy some property. That gets some of the property market back on track. Confidence then transpires across the nation. You start getting retail sales back, and all of it then starts flowing through. But at the moment, it's just everything is...
But that could take years.
Yeah.
Even if we start, no matter where we start now, it's going to take years. There's no fix. Like, you can't today go, tomorrow I'm going to fix all these debt problems, I'm going to fix unemployment. It's just impossible. But you have to have a starting point. And like Francis said, having these 31 points, I mean, I don't know how many points they've came up with in that week and a half, but let's say 150 points. But unless you're acting on them and you actually do follow through on them, it's just rhetoric, which is going nowhere, and you're not solving a problem.
So, Francis, final word to you then. If you have a choice, a government bailout of, Country Garden and the big developers, or let them go under, as Nitin says, which one do you choose?
I will let them go under because the properties market is something like 20% oversupply. So it will take years to absorb the existing inventory. So it's better to just let some of them go under.
Okay, well, this could well be a dramatic development. We'll watch it closely, see what happens. Thank you very much. You heard there Francis Lun, who is the CEO of GEO Securities, Nitin Dialdas, who is Chief Investment Officer at Mandarin Capital.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Let's have a look at the US inflation data first of all. Keenly awaited figures. US headline inflation, it did tick up slightly, 0.2% it rose month on month. That matched the previous month's rise, and it's the first time it's the lowest back-to-back rise in 2 years on a monthly basis, and then on an annual basis, 3.2% year over year, up from 3% in June, but slightly below economists' expectations of 3.3%. But it does bring an end to 12 consecutive months of declines in the consumer price index. So where do you think the Fed stands now? Is it satisfied, or is there more work to do?
I don't think they're satisfied. I think if you look at the September meeting coming up, it's probably on balance now only a 10% chance that they'll move. But interestingly, I thought the Fed governor Daly spoke later in the day after the CPI today and indicated that it was way too early to shout mission accomplished on interest rates and inflation. So, and you saw that reflected a little bit in the move in the bond market towards the back part of the session. Combine that with a weaker 30-year bond auction, I suspect that they're not done. They're more hopeful and confident that they might have peaked, but I suspect there's still a level of concern within the Federal Reserve that inflation's still going to be persistently high, and even if it's heading back and it's 3.2 and it's 0.1 better than we expected, it's still well short of the 2% target.
And how does it get back to that 2% target without doing a lot of damage to the economy?
Particularly, that's exactly the point. What you saw in the CPI figures, I think, was used car sales, airline prices, medical prices. These are pretty logical disinflationary moves because of demand and an overshoot probably in the price of used cars and airline prices, etc., and medical prices over the previous year. So those coming out really helped the CPI figure. Against that, you've still got quite a persistent high shelter cost in the US, rents and what have you. And that's the persistent piece that probably is most concerning to the central banks. And it's not inconsistent with what's happening here and around Europe as well. The shelter costs are persistently high, and what we're not seeing is a labour market softness that sort of mitigates the impact of that and the cooling off of that particular aspect of the inflation. So, I in overall sense, I think the Fed are probably going to hold September, but ready to fire if they see any other indicators.
And there's a lot of data that's going to come, isn't there, before September, because there's no there's no monetary policy meeting this month. So a lot of things could change between now and September.
Indeed. I think it's way too early to put a line on it. The vision of George Bush landing on an aircraft carrier and shouting "mission accomplished" after Iraq was somewhat salient in drawing a comparison, maybe.
I remember that.
Chairman Powell, saying much the same thing. I think it's definitely too early.
Do you think we're going to see talk at some point from the Fed about maybe learning to live with 3% inflation, particularly if it's going to be really hard to make that extra 1% drop in inflation without, as we say, causing a lot of damage to the economy? Do you think that's going to be an option for the Fed, that maybe we'll see talk about 3%? Well, actually, that's not so bad after all.
We've talked about this previously, and I suspect they'd be very reluctant to do that. And the reason that is because if they say they're comfortable with 3, then it'll be 4. I think because inflation's as much an expectation, and if people feel that prices are going to be higher and there's going to be persistently higher, they will be. It's not, and that I would think is the concern of the Fed, is that they don't want to create any expectation that they are prepared to give up the fight on getting prices back down to 2%, because they know in the long term that's the best thing for the economy. And so I suspect that they may live with 3%, but they're not going to tell anyone.
No, that's not going to become their official policy anytime soon anyway.
Correct.
What do you make of the reaction in the markets, particularly the bond markets? We've got what's known as bear steepening going on. So for listeners, that basically means yields are rising, but they're rising even faster at the long end of the curve. 10-year, 30-year bonds, the yields are jumping much higher than at the 2-year end, which is in effect steepening the yield curve, although because it's inverted, it just makes it less inverted. But this is, in many ways, not a good trade, is it?
No, particularly if you're for an equity investor, because the price to yield on stocks is driven off the 10-year. So as the 10-year goes higher, the earnings yield on stocks becomes a little less attractive. So that's one aspect of that. It also probably reflects that even if interest rates aren't going higher at the short end, they'll be persistently higher over the duration. So therefore the curve steepens off the back of that. So yeah, it's not a good sign. Having said that, I guess if people look at inverted yield curves and say as an indicator of recession, it may be somewhat of an unwind of that scenario, which suggests we might get the soft landing and the market's pricing that. But I think that's probably not the driver of long-term bond yields right now.
And it's sort of brought a halt, hasn't it, to the rally that we've been seeing in artificial intelligence stocks like Nvidia and others. This steepening yield curve and rising yields in general, it's not really great for those growth stocks.
Yeah, and I think one of the things that's probably emerging as concern is some of the default risk, some of the credit risk. If you look at the downgrades of the banks by Moody's, the previous one on the US economy last week, the sense that there might be some issue around credit quality, risk, that's always going to be reflected in higher yields at the long end. So a bit premature to say that that's the driver of it. But if the issuance in the Treasury auctions are starting to get a little priced a bit negatively, then that's probably going to feed through to the long end of the curve quite quickly. And that's something we're watching reasonably closely now, just some emerging signs of risk off.
And well, let's keep the inflation story going. If we go over to India, the Reserve Bank of India there kept its benchmark policy interest rate unchanged at 6.5% for the third consecutive meeting yesterday. That was in line with market expectations. However, it's raised its inflation forecast for fiscal year 24 from 5.1 to 5.4%, and has also warned that it expects headline inflation to surge in July and August, led by vegetable prices. There, it seems to be, after doing a pretty good job at taming inflation, they seem to be a bit worried all of a sudden.
India tends to live with a higher level of inflation, and the headline figure will be more volatile because they're the food prices have such a significant impact. So what happens with the monsoon season and the growing season really has a direct impact on prices, much more volatile series. Structurally, India has generally a high inflation. So what the Reserve Bank is saying is, look, we're staying put for the minute, but we do expect some volatility in the headline numbers of inflation, which may lead them to raise rates, but they tend to be able to persist with a higher level of inflation over time. So right now, I think they're sending a warning signal to the market that we need to be aware that we'll see higher prices most likely at the headline level and driven by food. But overall, structurally, inflation is going to be persisting in that high 4 to 5s. And that's something that they'll live with, I think, generally in India.
Now, if we move over to China, China has now fallen into deflation on both the consumer price side and the producer price side as well. The consumer price index down 0.3% year on year, although it did rise month on month, which has sort of rather negated some of the concerns there. But how much do you think China could export this deflation around the world and have an impact on what the Fed and other central banks are doing?
Yeah, I think it's an interesting story right now in China. So the export and import data, both substantially down. So exports down 14.5%. That reflects softer demand than what they had probably envisaged previously with the China recovery. Importantly, imports down 12%. So there is definitely a deflationary pressure on activity in the domestic economy. And one of the other aspects, I think, which is deflationary as well, is that they probably build up a lot of supply in expectation of the domestic recovery being much stronger. So you find that they're probably now having slightly big inventory build-ups across various sectors, which means some more discounting of prices to try to get sales, which has a further deflationary impact. And if the external economy, Europe and US, etc., continue to slow, then that's going to impact China even more, and so that exporting of deflation could persist. The other aspect, which is more structural, is that they're in terms of China is the pivot away from China as the hub for manufacturing and other, so other areas of Asia benefiting from that more structurally. The China plus one strategy of a lot of foreign firms now, not having everything in China and trying to reshore or to find countries like Vietnam, India, Philippines, etc. So there's a lot of things going on and a very interesting story in China right now.
I suppose the other problem with this is that if CPI and PPI are both now in negative territory, it means real interest rates are going up for businesses and for individuals, which of course is also a problem. So presumably somehow China's got to react in some way because it doesn't want to let the economy sort of slide into a deflationary spiral.
Yeah, I don't know clearly they've got the levers to be able to pull. They've got plenty of capacity to provide stimulus. It's an interesting conundrum right now. I don't know if we're at panic stations yet from a China perspective, but they're certainly probably disappointed with how things have gone. And you see that reflected in the property market most significantly, and that represents something, domestic of about 30% of GDP. So that sentiment doesn't help when you start to see things happening in the property market that continue to show stress.
Okay, Toby, that's great. Thank you very much indeed. Have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Le Shah, Asia Chief Economist at BBVA. Providing a view from mainland China will be independent economist Andy Sher. Have a great weekend.
Money Talk.